For more now on how to position through the quarter and the end of the year, PIMCO's Erin Browne. Welcome back. It's good to see you.
Nice to see you as well, Scott.
What do you make of this market action? I mean, I'll just ask you plain and simple. Have yields peaked?
So I think it's really hard to call the peak in yields. We still have massive Treasury supply, which is coming. I think key gate date is going to be the next Treasury refunding on November 1st. But I think absent that, with term premiums continue to rise, I think you can definitely say that the curve is likely to steepen from here. And it's very hard right now to call the peak in yields.
Are we on recession watch then, or how do you assess that?
I do think that we're heading to a much slower growth environment over the next year. Whether or not we tip over into recession, I think is a really hard call to make at this point. But I do expect that we're going to see growth slow below potential. We're going to have inflation gradually come down. And I think that the tails for the outcome, are particularly wide right now, which does make uncertainty high and make it a really tough environment to be directionally long equities. Between now and year end, I think it's fine, because of seasonal effects, because, we've sold off recently. I think it's fine to have a little bit of a long going into year end. But as we turn the page into next year, I think those interest rate sensitive sectors of the economy are going to be hit hard. And they've done pretty well year to date. So I think that's really the key area to watch. Interesting,
though. You do think that we could actually rally between now and the end of the year? Because I don't know, the last handful of days as rates, 5% seem to be the line in the sand. If you're going to continue to go above 5%, it's like, OK, well, maybe that's going to upset plans that the bulls had for a late year run.
So I think the market's largely been pricing in higher and higher yields, really for the bulk of 2023 and 2022. And that's why, we've come off pretty significantly over the last 3 months and really in the third quarter with respect to equities. Going into year end, we have an earnings season which is set up optically to look actually pretty decent. We're going to get about a third of the S&P reporting this week. But I think you're going to have and hear pretty decent earnings coming off of what continues to be a pretty strong economic environment. So I think for that could set up pretty nicely for a year end rally. That said, I think what's going to be really key is how companies are indicating for the year ahead. And I think you could see a lot more ambiguity, a lot more uncertainty. So, while I expect that we'll see pretty decent earnings this year, for the rest of this year, I think as we move into the, 2024, the earnings setup is going to be a lot more difficult. So I would say, buy on a tactical basis, but get ready to start to sell as we move into 2024 on what I think is going to be much tougher comps next year.
I'm sorry to step on your toes there. You are a PM over there, portfolio manager. What's your biggest position right now?
Right now, our biggest position is in duration. I mean, we think that duration right now, not too dissimilar from the comments that were made, overnight by some of the tweets we've heard from some of the hedge fund managers. We think duration is, pretty attractive at these levels, particularly for medium to longer term investors. Mortgages, agency mortgages, just given the sell-off, are really cheap versus intrinsic value. So we also think that looks attractive. In equity space, we're long quality, we're long some more defensive assets, and short some of the cyclicals, specifically consumer cyclicals like autos and home builders against it.